U.S. interest rates in 2025 continue to be characterized as elevated, with the Federal Reserve implementing a slower pace of rate reductions than many had originally anticipated. This dynamic has led to increased interest in alternative areas of the income market that take advantage of these higher rates, like private credit, which consists primarily of floating rate loans. Business development companies, or BDCs, are one segment of the private credit market that is attracting investors who are seeking high yield, diversification, and ease of access to private markets. BDCs are investment companies that provide financing, primarily through direct loans, to small and mid-sized private businesses, who often go overlooked by traditional banking institutions. Interest and fees are collected on these loans and then distributed to BDC shareholders. BDCs give investors access to the income potential of private credit, a market segment that has traditionally been difficult to access to many. And unlike traditional private credit funds, which often require capital commitments, have lockup periods, and redemption limits, many BDCs offer the distinct advantage of being publicly traded. Investors can buy and sell shares of BDCs on public exchanges, just like a regular stock, allowing for flexible exposure. This liquidity positions BDCs as a compelling alternative for investors seeking exposure to private credit without sacrificing the ability to adjust their portfolios as market conditions evolve. A key feature of BDCs lies in their high allocation to floating rate loans. When interest rates rise, the interest paid on these loans also increases, boosting BDC investment income and in turn, supporting higher dividends to investors. This direct link to interest rates can be especially beneficial in elevated rate environments like today, where many BDCs are offering double-digit yields. In lower rate environments, BDCs can still offer attractive income. Interest rate floors embedded into their loan agreements help ensure a minimum yield regardless of how far rates decline. Additionally, the private credit nature of these loans provides higher spreads over benchmark rates compared to public debt, which further helps preserve income potential across rate cycles. For instance, during the near zero interest rate period just a couple of years ago, BDCs still delivered upper single-digit yields. However, a challenge that many investors face when considering allocating to BDCs is selecting from the many that are available in the market today. BDCs are complex entities, each with their own distinct risk profile, shaped by management philosophy, underwriting standards, credit profiles, and underlying asset exposures. Because of this complexity, investing in individual BDCs requires thorough and time-consuming research to fully understand each entity. The VanEck BDC Income ETF, ticker BIZD or BIZD, addresses this by offering diversification across the whole BDC industry. By tracking a passive index focused on the most liquid segment of the BDC universe, BIZD provides broad market exposure to a range of BDCs, simplifying the investment process while maintaining the benefits of the asset class. This reduces the burden of individual credit research, providing an efficient solution for investors seeking exposure to this complex asset class. So, to recap, BDCs offer liquid access to private credit with high income potential and a floating rate structure that is well suited for the prevailing interest rate climate of today. The VanEck BDC Income ETF simplifies exposure to this diverse asset class, mitigating the complexity of individual BDC selection. As the high interest rate environment persists, BDCs stand out as a compelling option for income-focused investors